Hi there. In this topic video, we're going to focus on household saving. It's part of our study of aggregate demand and the economic cycle. Saving essentially is when people decide to defer their spending. In other words, it's the bit of disposable income which is not spent on goods and services and saved. All kinds of different ways in which you can save your money. Bank and building society accounts, in occupational pensions, all kinds of different savings instruments. But fundamentally, it's about how much of your disposable income you choose not to spend. Key point is that saving is not a component of aggregate demand. But if people choose to save more, for example, then by definition, for a given level of income, they'll be spending less. So saving decisions affect consumption decisions and vice versa. Key measure of savings is something called the household savings ratio, and that's simply the percentage of people's income after tax and benefits that they choose to save. So if you have an annual income of £25,000 and you save £2,500, then you have a savings ratio of 10%. Many of the determinants of saving, as we'll see, are actually the reverse of those which affect consumer spending. Now, why do people save? Well, here's some evidence from the United States. Perhaps this applies to other countries as well. But the main motivations for saving are to save for a rainy day, unexpected bills, for example. A lot of people now are thinking about retirement as years of healthy life expectancy go up. How are they going to fund their after work years? People saving for a holiday, to pay college fees, major items of consumer spending such as a new car. Saving for a deposit for a mortgage is important, particularly in the United Kingdom where house prices are so high. And saving to pay for the costs of a marriage, even a funeral, life, births and deaths. Now this is quite important, I think, in the context of saving in Britain. The evidence suggests that around 1/5 of people of households in the UK have no savings at all, or barely any savings. This is a staggering statistic, but I think it's important to be aware of this as part of your macroeconomics. Many people barely cover their bills from month to month, and we'll have seen the rise of the payday lenders and some other forms of high-cost finance. Savings in the UK are pretty low. Indeed, if we look at the savings for all families with savings, around a third have less than £500 tucked away, 40% less than £2,000, just under a half have less than £5,000, and 75% of people, 3/4 of households, have less than £50,000 saved. So that's quite important. The key thing to take away from this slide is that the average level of savings in the UK is actually pretty low. The savings ratio I mentioned just a minute or two ago, and this is the green line on this chart. The red bit is the annual change in household spending, and you can see that it rises most years, except in 2009, which of course was a year of deep recession. Notice what happened to the savings ratio in 2008 through to 2010. It nearly doubled. Now, a higher savings ratio is going to reduce consumption, thus dampening aggregate demand. And that has consequences for the economic cycle, for growth, for jobs, for inflation. Crucially, of course, savings going up might be the result of people deciding they have to pay their debts back. So that has long-term consequences as well. The savings ratio has been falling in recent years. It's heading down towards 4%. And a lot of people are thinking, is that a sustainable fall in savings? What happens if we hit another tough time? Will people have enough savings to fall back on? Now, what are the key factors affecting saving? There's a lot of text in this chart, and I apologise for that, but if you want to read through it at your own pace, just press the pause button. These are the key factors that drive saving. I think one of them I'll point out to you is the real interest rate. So that's the nominal rate of interest minus the inflation rate. And normally when interest rates are positive, people will tend to save more. And there's an incentive there. The rate of inflation affects the value of savings. So for example, if the inflation rate's 5% and interest rates on savings are only 2%, then that might disincentivize saving because the real return on your savings is minus 3% per year. Equally, in a world of deflation, people may choose to save a little bit more if they can, because they expect prices to fall a bit further. I think importantly, the level of saving is determined by your consumer confidence, by the state of your job security, whether you feel the economy is heading in the right direction, your own personal circumstances. Typically, when confidence is declining, people save more. It's a natural instinct. And John Maynard Keynes called that a deterioration in animal spirits, prompting people to save more. Of course, collectively, if we all save more, then aggregate demand falls and the economy might be worse off as a result. Tax is important. The taxation of savings can have an effect. In the UK now, something like the first £1,000 of interest on your bank account is pretty much tax-free, and that's designed to try and encourage more people to put money away. Many factors affect savings, just worth bearing in mind some of the key ones and being able to explain them. And finally, just a little look at why savings are important, sort of from a macroeconomic perspective. Businesses save as well as households, and if businesses have that kind of buffer stock of cash or savings, then that could be useful if market conditions worsen. The financial system needs savings. The savings provide funds for firms ultimately to borrow and invest from the financial sector. Savings for pension funds, and those often are reinvested in the stock market. And crucially, households, they need savings as well. They need them as a buffer to help smooth their consumer demand, their household spending during difficult times. And of course, with the long term in view, many people now thinking about how best to save for their retirement, especially if the value of pensions from the state continue to decline in relative terms. Of course, this all depends on people and businesses being able to save, and that's really quite an important evaluative point. So there we go. We've touched on what savings are. We've looked at some of the factors affecting savings and mentioned a few reasons why it's important to look at the savings ratio, for example, if you want to improve and deepen your understanding of macroeconomics. Thanks for joining in on this little revision tutorial. Plenty more on the website, obviously. I hope to see you again sometime soon.